the question, we can throw that up there. I got producer Ethan over here trying to run the show. Lorraine had asked, what is your opinion on investing in gold? Gold's a hot topic right now, right? Everybody wants to be in gold or wishes they had been in gold because it's up a bunch, like a lot. So I'll show you this chart here. We've got the let's just look at the last 10 years, right? So gold over the last 10 years. Actually, let's look at this chart up here. Historical chart, right? Yeah, like 10 years ago, it was $1,000 an ounce. It's up like 5x, right? 50 something, 5,000 something right now. Right? I think it's down a little bit, but it's still pretty close. And so that's awesome, right? A 5x return over 10 years is just awesome. And so everyone's like, should we be investing in gold? What do you think about investing in gold? All those things, which is I just want to first say it's a very normal thing to do, right? Most people see something's going well and they're like, should we be in on this? It's called euphoria or buying high, right? We always want to be in something after it's gone way up. So I want to give you a little bit of context for this. So first of all, what's my opinion on investing in gold? Number one, I guess, gold is not an investment. So you can buy gold. In my opinion, you can't invest in gold, right? It's a little bit semantics, but the real things you invest in future cash flows. That's what an investment is. If you buy a bond, you are buying a bond because it is now going to pay you interest payments for a set amount of time, and then you get your money back. Right? If you buy a CD, it's going to build up interest inside of there, and then you're going to get your money back plus that interest. Right? If you buy a business, like either in the stock market, you're buying an ETF full of businesses or Apple stock or whatever else, you are buying the future cash flows of that business. Right? I'm going to put $1,000 into this business, and I expect that they are going to generate profits that I now get as the owner over time, and then eventually hopefully can also sell that share to someone else, and it'll be worth more when we paid for it. And so just, I'm what I call an equity evangelist, right? I share the good news of owning the best business in the world. And so, right, when you invest in equities, right, there's two ways you make money. One is the dividends, the profits that you get as an owner, right? And the other one is appreciation, which is the businesses get better, right? They were worth more than when you paid for them, right? When you buy gold, there's no number one. Just doesn't, like, there's no interest income, there's no profits paid out, there's no cash flows. You just buy it, and you buy it at one number, and you hope that later someone else will pay a bigger number for that, right? It's called it's not so much for gold. People don't use this a lot for gold, but they'll use this a lot for other speculative things you can buy, right? So it's called the greater fool's strategy, right? Or, hey, I'm going to buy this, and I hope sometime down the road, someone else will be a bigger fool than I am and will buy it from me at a higher price. But gold doesn't produce anything. It doesn't treat any diseases. It doesn't solve any problems in people's lives. It doesn't earn any money. It doesn't produce. It's not an investment like anything else that we would invest in. It's a commodity, right? That's what it is. It's a hunk of metal, or it's a ETF that owns a bunch of hunks of metal, right? And so I'm not saying that no one should ever have it. It's just not really an investment, right? And so here's some context, because I think investing is always good in context. So if we go back to these charts over here, right? Over the last 10 years, it's been awesome. And if we look at the 50-year history of gold, right, we can actually look all time, right? So it was really stable for a long time, gold standard and all that, went away, and then it spiked way up, right? So we're gonna miss a lot of this growth here from I guess I can just slide this over. Look at that, what a dream, right? So from like 1970, it went from $35 an ounce to 670, I think is where it peaked, somewhere in there, which is like, I don't know what kind of X return that is. It's incredible, right? Let's just look at the last 50 years. We'll zoom in a little bit, right? So peaks way up at 670, I think. There we go, 670, right? And then it went down, and it just kind of hovered around for a long time. And it took until, here we go, where is it, right? Somewhere in here, right? There's 678. 2007. So from 1980 to 2007, for 27 years, that's how long it took to break even from its prior high, whatever amount, right? 27 years. If you look at inflation, ooh, that was fancy. If you look at inflation, right? Let's look at 50 years with inflation, right? So now inflation dollars, right? This would be 2,700. And here's your 2007. You're actually still way down. And you almost caught up here, because again, it was 2792. And we have to go all the way until 20, somewhere in here. We'll just give it right there. Last year, October 22 years ago, a year and a half ago, October 2024, for you to catch up with inflation. So 1980 to 2024, it's 44 years to actually make any real money if you had bought it back at the peak in 1980, right? Which is incredible. And so it's not great. The thing about let me actually, can I share? I think I can switch this. Stop that one, and then let me share. I like to use I have big fancy tools. I like to use tools that you guys can use, that anyone can use, and show things on here. So let's go. You can throw that one up there. Let's even just look at the last 10 years. Right. So if we look at the S&P 500 over the last 10 years, it's just like Apple's stocks app. You have it on your phone. You have it on, if you have a Mac, you have it on your Mac. So we can see that over the last 10 years, the S&P 500 is up 243%, which is awesome, actually. And then the gold ETF over the same 10 years is up 291, right? And so again, you're up. Gold has done better than equities over the last 10 years, right? Or so it seems, right? But again, if we go back to our other charts over here, or our things, real, the investments, right? Equities go up and down. They go up in value, but they also pay a dividend. It's usually a percentage of their value. And so as the value goes up, the dividend payments also go up, your dividend income. And these two things together, 1 and 2, are called your total return. And ultimately, that's all we should care about. Total return, both of these things put together. Or in this case, just the one, just the value going up. Because again, it doesn't pay anything, right? And so a lot of times we can look at things like this and we say, oh man, gold has really crushed the S&P 500 over the last 10 years. And it's just not true. Let's go back and look at, let me stop this one. We'll go back to our other, I can only share one screen share thing at a time. Let's go back to here. So here's another one. I actually like this one a lot. Don't quit your day job is what this stands for. But they have an S&P 500 return with dividend reinvested, right? So if we look at even the last 30 years, we're looking at 30 years of inflation or 30 years of retirement, right? From March of 96 to March of 2026, the S&P 500 is, actually, let's do 10 years first real quick. I think I have that right here. So same 10 years, 2016 to 2026, there's your same 240%, right? This is like month-end returns. So it's going to be slightly different than the Apple Stocks app, which shows 243, right? But, so a 13% annualized rate of return, which is awesome, by the way, and not to be expected. But the total return, if you reinvest those dividends, is 300%, right? So we're still up over the 291 that gold is over the last 10 years, right? But here's the other thing. Right. So if you look over the last 30 years, you're up, 10% on average. This is, again, if you look at most 30-year returns, S&P 500 just kind of averages out to 10% with dividends reinvested, total return, right? Gold over that same 30 years, 96 to 2026, about 8.8. Okay, so less, but still pretty good. If we adjust these, let's take, where's my keyboard? It's way over here. Let's take from 94. Let's just back off 2 years. Now your total return, your annualized return, is 5.8% in gold. Right? We come back over here to the S&P 500 and we back this one off by 2 years. Total return still about 10%. Right? Because here's the deal. Right? Again, if we look at this, most of this return is just in the last couple of years here. It's going crazy because people are worried about other things. Just like there's a few other stretches in history. This is the inflation adjusted one, right? A few other times in history where it went crazy. And if you were one of the people that, hey, it's going crazy, I want to invest here. Great. 27 years before you break even nominally, and 44 years before you break even with inflation. Do we want to do that? Do you want to buy gold now? Maybe it'll keep going up, right? Maybe we are here in the cycle, right? Maybe we'll dip and then maybe it'll still double or triple or whatever again. I don't know, right? Nobody does. But there's also the chance that because it doesn't produce anything, it's only worth what someone else is willing to pay for it, that now is the peak right here, and it's going to be 44 more years before it breaks even with inflation again. Is that how you want to invest? And so here's if we go back to our chart, right? Here's how we invest. If your money is on the line, your retirement, all those things, invest in things that I don't know how to write this out really easily, but invest in things that always work. Always work. Investing in the S&P 500, investing in equities and best business in the world has always worked. Right? We just talked about it in the earlier segment. You can pull 5% a year, more sometimes, whatever else, and like over almost all 30-year periods, it's averaging 10%. There's a way to pull it depending on what the market's doing. Ways to make that very secure, and it always works. If you're investing in things like gold, which usually don't work, and then occasionally have these big spikes, right? Well, you can't hold that for 30 years, or you shouldn't, because most of the time when you hold that for 30 years, you're looking at a 4 or 5% return or a negative return, depending on when you bought it for a super long time. So again, do we want to invest in gold with a 5% rate of return? Or do we, that may be negative for a long time, may take 44 years to break even, may do all these other things? Or do you want to invest in something that has a very strong historical average of 10% over long periods of time? Right? You tell me. I want to do things that always work, because if you're trying to invest in things that only sometimes work, then you have to time it. And when you time things, right, you have to be right twice. You have to be right when you get in and when you get out. And if you're wrong when you on one of those things, let's say you get in here instead, and then you get out there, well, now you're wrong both times, right? Maybe you get in here, and that you were right on the way in, but you didn't get out, and then you didn't get out again until here. And maybe if you made some money, you made 3% over that time, which wasn't that great, right? So when you're trying to time things, whether it's trying to time the market or trying to time a specific thing, you have to be right both times, when you get in and when you get out. And unless you're really good at that, which nobody is, by the way, I wouldn't try it. And so we always say, like, hey, with the majority of your money, the money you need to live on, you should always invest in a strategy that always works, which we just kind of covered. Red bucket, blue bucket. That's what we teach in here. This strategy historically has always worked. And when you do that, it creates more tax issues because you've got a bunch more money, which is why you will need this book. And if you're watching this, because we'll probably clip this and make it a separate "Should I Invest in Gold" video. It was a different. Go back to our channel. There's another video that we made that I was just referring to. So that's what I think about investing in gold. It's not an investment. We should invest in things that always work. If you have side money, right? Hey, I got enough to live on. We have extra money. I want to play around with it. I want to try single stocks. I want to try Bitcoin. I want to try gold. Whatever. Great. If you bought gold back in 2024, good for you. Awesome. It's the same thing for people who bought Bitcoin before it went crazy, before people who bought Amazon, Apple before they went crazy. There's plenty of examples of people who bought at the right time and got lucky. That's just not necessarily repeatable. And so if we're looking forward, and there are no facts about the future, we want to invest in things that we know have always worked. So hopefully that's helpful. That's what I think about investing in gold. If you have extra money, knock yourself out. If it's what your life savings is depending on, I don't know that I'd buy high. Not sure that that's when I want to do that. But again, this is not investment advice because I don't know who's watching this. So if you want investment advice, then you can come talk to us.